billion gone. Not because hackers stole it, not because the market crashed. It disappeared because one of the world's most trusted cryptocurrency exchanges quietly broke the oldest rule in finance: never gamble with your customers' money. Hundreds of thousands of people logged into their accounts one morning and discovered they couldn't access their savings, not because of a technical glitch, because the money they believed was safely sitting in their accounts had already been spent. This is the story of FTX. And let me be clear from the start, this isn't just a crypto story. It's a story about trust, about how a 30-year-old built one of the most respected financial companies in the world, convinced investors, regulators, celebrities, and millions of customers he was one of the good guys, then quietly gambled away billions of dollars that didn't belong to him. By the end of this video, you'll understand exactly how it happened. More importantly, you'll understand the one governance failure that made it possible, because every corporate collapse leaves a trail. Tonight, we open the FTX file. Sam Bankman-Fried founded FTX in 2019. At the time, cryptocurrency was becoming mainstream, but many exchanges still looked unreliable or unsafe. FTX looked different. It looked professional. It looked legitimate. Customers flooded in, while some of the world's biggest venture capital firms invested billions. By early 2022, FTX was valued at $32 billion, making it one of the largest cryptocurrency exchanges in the world. And the man behind it didn't look like a billionaire. People called him SBF. He wore cargo shorts and wrinkled t-shirts. He slept on a beanbag in the office. He played video games during investor meetings. To many people, that wasn't unprofessional. It felt authentic, like a brilliant outsider who cared more about solving problems than making money. The media loved him. Politicians invited him to Washington to discuss crypto regulation. Tom Brady became a brand ambassador. Stephen Curry promoted the platform. Larry David appeared in a Super Bowl commercial. FTX even bought the naming rights to the Miami Heat arena. Everything pointed to one conclusion: success. And that's exactly what made what happened next so dangerous. Because behind the headlines, behind the celebrity endorsements, behind the $32 billion valuation, FTX wasn't really one company. It was two. And that relationship explains almost everything that followed. Every major corporate fraud begins with an exception. We'll fix it later. It's only temporary. It won't become a problem. Sometimes those exceptions disappear. More often, they become the beginning of the collapse. Let's start with the part of the story most people know, because it matters more than you think. Before FTX ever existed, Sam Bankman-Fried had already founded another company, Alameda Research. Founded in 2017, Alameda wasn't a cryptocurrency exchange. It was a trading firm. Its job was simple: buy, sell, borrow, trade, take risks. Then, in 2019, Sam launched FTX. Officially, the companies were separate. FTX held customer deposits and processed trades. Alameda traded using its own capital. On paper, there was nothing unusual about that. Many businesses own multiple companies. The problem isn't ownership. The problem is what happens when the line between those businesses begins to disappear. Imagine owning both a casino and the bank where customers keep their savings. The casino exists to take risk. The bank exists to protect deposits. Those two businesses can never behave as one, because the moment customer money starts funding casino bets, trust disappears. That's the line FTX was never supposed to cross. Its own terms of service made that clear. Customer assets belong to customers, not FTX, not Alameda, not Sam Bankman-Fried. But behind the scenes, that line was already beginning to blur. According to bankruptcy investigators and federal prosecutors, Alameda wasn't treated like every other customer. It received special privileges, special access, exemptions from rules everyone else had to follow. That alone should have raised questions. Not because special treatment automatically means fraud, but because some of the biggest corporate failures begin exactly this way, with trusted people receiving exceptions. And exceptions have a habit of multiplying. Here's where every auditor, compliance officer, and board member should pay attention. Related party transactions aren't unusual, they're common. That's exactly why they receive more oversight, not less. Independent approvals, documented conflicts of interest, restricted access,
Because the question isn't whether you trust the CEO. It's whether the controls still work when trust is removed. At FTX, that question was never properly answered. Outside the company, almost nobody knew any of this. The headlines focused on explosive growth, celebrity endorsements, record valuations. As long as customers could deposit, withdraw, and trade, nobody looked behind the curtain. But behind that curtain, Alameda wasn't just receiving special treatment anymore. It was running out of money, and when the losses began piling up, someone made a decision that would destroy the entire company. A decision involving money that was never supposed to leave the exchange.
By early 2022, the cryptocurrency market was beginning to crack. Prices were falling. Major crypto firms were collapsing. Lenders wanted their money back. Behind closed doors, Alameda Research was in serious trouble. Now, that alone wasn't unusual. Trading firms lose money. They make risky bets. Sometimes they win, sometimes they don't. That's the business. The problem wasn't that Alameda was losing money. The problem was where it went looking for help. Instead of raising new capital, selling assets, or accepting its losses, Alameda turned to the one place it should never have touched: FTX customer deposits. Think about that. When people deposited money into FTX, they believed it would be there whenever they wanted to withdraw it. It wasn't investment capital. It wasn't company revenue. It wasn't Sam Bankman-Fried's money. It belonged to customers. Yet according to federal prosecutors and bankruptcy investigators, billions of dollars were quietly transferred from FTX to Alameda to keep the trading firm alive. No announcement, no customer consent, no disclosure. Just customer money moving from one company to another, both controlled by the same person. Imagine depositing your paycheck into a bank, only to discover the bank quietly loaned your money to its owner's struggling business without asking your permission. That's exactly what prosecutors say happened at FTX. But moving the money was only half the story. The bigger question was, how did nobody notice? Investigators later discovered that Alameda wasn't treated like an ordinary customer. While everyone else had to maintain positive balances, Alameda could continue trading even after its account went deeply negative. Think about how extraordinary that is. Imagine overdrawing your bank account by millions of dollars, and instead of freezing your account, the bank simply says, keep spending. For every other customer, the rules were enforced. For Alameda, the rules disappeared. That wasn't a software bug. It was a management decision. And every exception made the next one easier. Because once controls become flexible, they're no longer controls. This is where the story stops being about cryptocurrency and starts becoming a governance failure. Good governance isn't built because companies expect honest people to become criminals. It's built because pressure changes decisions. That's why financial institutions separate duties. No single executive should be able to move billions of dollars of customer money without independent oversight. Treasury monitors liquidity. Finance reconciles the books. Risk monitors exposure. Compliance challenges unusual transactions. Internal audit tests whether those controls actually work. Because when pressure rises, people tell themselves the same things. Just this once. We'll put it back later. Nobody will notice. Those have become some of the most expensive words in corporate history. At FTX, those safeguards either didn't exist or they weren't allowed to work. All it needed was one person to ask the wrong question. That question arrived on November 2nd, 2022. For years, almost nobody outside FTX knew any of this. Customers kept trading, investors kept investing, the valuation kept climbing. From the outside, everything looked normal. Then, on November 2nd, 2022, one article changed everything. Crypto news outlet CoinDesk obtained a copy of Alameda Research's balance sheet. At first glance, nothing looked unusual, but one detail immediately stood out. A huge portion of Alameda's assets wasn't cash. It wasn't Bitcoin. It wasn't Ethereum. It was FTT, a cryptocurrency created by FTX itself. If you're not familiar with crypto, here's why that mattered. Imagine applying for a mortgage using coupons your own company printed. On paper, they might look valuable, but they're only worth something if someone else believes they are. That's essentially what Alameda had done. Its financial strength depended heavily on a token created by its own sister company. The moment confidence in FTX disappeared, so did the value supporting Alameda. The market understood that almost immediately. Then came the second blow. On November 6th, Binance CEO Changpeng Zhao, known as CZ, announced that Binance would sell all of its FTT holdings. The market panicked. FTT's price plunged. Customers started asking questions. Then they started withdrawing their money. Billions of dollars flowed out of FTX in just a few days. Now here's the important part. Customers withdrawing their own money shouldn't destroy a healthy financial institution. Banks process withdrawals every day. Investment firms process withdrawals every day. Crypto exchanges should be able to do the same. This wasn't just panic. It was a stress test, and FTX failed it. When customers asked for their money, FTX couldn't produce it. Investigators later estimated that FTX owed customers roughly $11.3 billion, but had only about $2.3 billion readily available. An estimated $9 billion was missing. The money customers believed was safely sitting in their accounts simply wasn't there. Sam Bankman-Fried went on social media insisting FTX was fine. He claimed competitors were spreading false rumors. He urged customers to stay calm. Less than 24 hours later, withdrawals stopped. Customers could still see their account balances. They just couldn't access their money. At that moment, the story stopped being about cryptocurrency. It became a liquidity crisis, and then a solvency crisis. Notice what finally exposed FTX. It wasn't an annual audit. It wasn't the board. It wasn't internal audit. It wasn't compliance. And it wasn't regulators. It was one leaked balance sheet that forced the market to ask a simple question. Can this company actually pay back what it owes? Sometimes billion-dollar frauds aren't uncovered by brilliant investigations. They're exposed because someone asks the question nobody else thought to ask. That's why we say, follow the paper trail, because numbers usually tell the truth long before people do. Back inside FTX, the situation was spiraling. Bankman-Fried desperately searched for rescue financing. Then came what looked like a lifeline. Binance signed a non-binding letter of intent to acquire FTX. For a brief moment, it looked like the company might survive. Then Binance reviewed the books. Within a day, it walked away. No rescue, no bailout, no deal. Whatever Binance found, it was serious enough to abandon one of the biggest rescue attempts in crypto history almost immediately. Just days after the CoinDesk article, the empire had collapsed. On November 11th, 2022, it was over. FTX, Alameda Research, and more than 100 affiliated companies filed for bankruptcy. Sam Bankman-Fried resigned as CEO. A company valued at $32 billion just months earlier had collapsed in less than 2 weeks. But balance sheets don't tell you what bankruptcy feels like. People do. Millions of customers suddenly found themselves locked out of their accounts. Some couldn't pay rent. Some couldn't access business funds. Others watched years of savings disappear overnight. Many had never intended to make risky bets. They simply believed FTX was a safe place to store their digital assets. Instead, their money had been used to support a trading firm they didn't even know existed. That's what made this more than a business failure. It was a betrayal of trust. Then came the man tasked with finding out exactly what had happened. John J. Ray III. If that name sounds familiar, it should. Ray wasn't brought in because he understood cryptocurrency. He was brought in because he understood corporate disasters. He had previously overseen the collapse of Enron, one of the largest accounting scandals in American history. He had spent decades untangling failed companies, accounting fraud, hidden liabilities, destroyed governance, missing records. If anyone was difficult to shock, it was John Ray. Yet after examining FTX, he wrote something extraordinary. Never in my career have I seen such a complete failure of corporate controls. Think about that. Not from a journalist, not from a politician, from the man who cleaned up Enron. Investigators described unreliable financial record, poor bookkeeping, major decisions approved through disappearing messages, corporate funds used to buy luxury real estate, basic governance practices that were ignored.
or simply didn't exist. This wasn't just fraud. It was an organization operating without the systems designed to prevent fraud in the first place. Corporate controls rarely make headlines until they're missing approvals, audit trail, reconciliation, documentation. They may seem boring, but they're the difference between a mistake and a multi-billion-dollar collapse. Healthy organizations can answer simple questions. Where did the money go? Who approved this? Where's the evidence? At FTX, those answers were remarkably difficult to find. And when an organization can't explain where customer money went, trust disappears long before the company does. That's why we keep saying, follow the paper trail. The bankruptcy answered one question, where had the money gone? But another question remained, who was responsible? To answer that, federal prosecutors would have to prove this wasn't simply a failed business, it was fraud. And that would lead to one of the biggest financial trials in recent history.
The bankruptcy answered one question, where had the money gone? The criminal trial had to answer another, who was responsible? Federal prosecutors argued that Sam Bankman-Fried hadn't simply run a poorly managed company. He had orchestrated a years-long fraud. According to the government, customer funds were secretly diverted from FTX to Alameda Research, while customers were repeatedly assured their assets were safe. The case wasn't built on one dramatic email or one secret recording. It was built piece by piece. Financial records, computer code, internal communications, corporate documents, and perhaps most damaging, the testimony of the people closest to him. Caroline Ellison, Gary Wang, Nishad Singh. Each admitted their own role, each pleaded guilty, and each testified that Sam Bankman-Fried directed key parts of the scheme. Their testimony painted the same picture. Customer money moved where it wasn't supposed to. Special privileges were quietly granted. Controls were bypassed. And inside the company, extraordinary decisions slowly became normal. The defense argued something very different. FTX had simply grown too fast. Mistakes had been made. This was poor management, not fraud. But prosecutors argued that poor management doesn't explain secretly moving billions of dollars of customer money. The jury agreed. After only a few hours of deliberation, Sam Bankman-Fried was found guilty on all 7 criminal counts. In March 2024, he was sentenced to 25 years in federal prison and ordered to forfeit billions of dollars. He later appealed, but in 2026, the U.S. Court of Appeals upheld both his conviction and sentence. Legally, the case was over. For many customers, the damage wasn't. Some eventually recovered much of their money through the bankruptcy process. But trust is much harder to recover.